All right, so today we're going to talk about a really interesting company. It's in an industry that's getting absolutely hammered right now, but some investors think it has this incredible secret weapon. We're talking about Rush Enterprises. They're the biggest commercial truck dealership in all of North America, and we're going to dig in and see why it's such a puzzle for investors.
So let's just get right to the big question, the paradox that every investor has to be asking themselves. The company's own leadership calls the current market a freight recession that's been going on for over 2 years. So you've got to ask, right? Why on earth would you even think about investing in a truck dealership right now?
And it's not just talk, the numbers are pretty stark. We're looking at a forecast for a 10.5% drop in sales for the big rigs, the Class 8 trucks. I mean, that is a huge hit. If you think Rush is just in the business of selling new trucks, a number like that looks absolutely terrifying. But, and this is the whole key to the story, that's not the whole picture, not even close. To really get what's going on with Rush, you have to ignore the flashy truck sales numbers for a second and look at what's happening under the hood. This is where we find the real profit engine. Okay, so take a look at this. It's kind of surprising, right? You'd think a truck dealership makes all its money selling trucks. And yeah, that's where most of the revenue comes from. But look at where the profit comes from. Over 60% of their gross profit isn't from selling new vehicles at all. It's from the aftermarket. We're talking parts and service. That's the real cash cow here.
You've probably heard of this before. It's the classic razor and blade model. You sell the razor, the truck in this case, maybe on a pretty thin margin. But the real money, the recurring profit, comes from selling the blades over and over again. And for Rush, the blades are all the high-margin parts and services that every single one of those trucks needs for years and years to come. It's a brilliant setup.
Now, there's actually a specific metric that shows you just how powerful this model is. It's called the absorption ratio. And honestly, if you're going to invest in this industry, this is probably one of the most important numbers you need to understand. It tells you almost everything. So check this out. Russia's absorption ratio last year was over 132%. Think about what that means. The profit from just their parts and service business, it pays for all of the company's fixed costs, all the rent, all the salaries, the whole shebang. And it still has 32% profit left over before they've sold a single truck. It means that any profit they make from actually selling a vehicle is basically pure gravy. It's an incredible cushion. Okay, so now that we get how that engine works, let's put it all together and build the bull case. What's the argument for actually owning Rush stock, especially when things look so bleak on the surface? Well, the bulls will point to three main things. First off, just sheer unmatched scale. I mean, with over 200 locations, they have this massive network. If you're a big national trucking company, you can get service anywhere. Your local mom-and-pop dealer just can't compete with that. Second, obviously, is that aftermarket business we just talked about. It's super resilient and spits out cash. And third, they're a smart acquirer. They've built this empire by constantly buying up smaller, fragmented dealerships and plugging them into their system. All right, but it can't all be good news, right? Of course not. Every investment has risks. And for Rush, there are some pretty big ones you absolutely have to consider. So let's flip the coin and look at the bear case. The skeptics will bring up three main worries. First, look, that aftermarket cushion is great, but you can't hide from the economy forever. This is still a cyclical business tied to the health of the trucking industry. Second, and this one's a big deal, they're really dependent on their big partners, like PACCAR and Navistar. Their franchise agreements actually have clauses tied to the founding Rush family. That adds a layer of risk you don't see everywhere. And finally, you've got this huge question mark of disruption. New EPA rules are coming in 2027, and nobody knows exactly what the long-term shift to electric or hydrogen trucks is going to look like for their business model. So this brings us to the million-dollar question for any investor looking at this stock. How do you even begin to put a price on a company like this? It's like you've got two completely different businesses mashed into one, and that creates a real valuation dilemma. One way to think about it is with a sum of the parts view. Basically, you try to value the two pieces separately. On one hand, you've got the cyclical truck sales business. It's volatile, lower margin, and it goes up and down with the economy. But on the other hand, you've got this super stable, high-margin aftermarket business. And that part of the company looks a lot more like a steady industrial distributor than a vehicle dealer. And that really gets to the heart of the bull argument on valuation, which is this. The market might be making a mistake. It might be looking at the shaky, cyclical truck sales, and it's letting that drag down the value of the whole company. The big question is the market unfairly punishing the fantastic, stable aftermarket business just because it's attached to the dealership? Is there a hidden value here that people are missing?
So, in the end, it all boils down to this one question. What is Rush Enterprises really? Is it a resilient fortress built on a powerful service moat that can withstand any economic storm? Or is that just a story, and at the end of the day, it's just another cyclical stock that's always going to be at the mercy of the wild swings in the trucking industry? That's the puzzle you have to solve.